Good evening to everyone. We will start the lecture. So even though the less number is attending, we will start. Otherwise, we will not be able to cover all the areas and to take two case study presentations. So today, group number 3 and 4 will present respective cases, that is case number 3 and 4. I hope that you are ready for that. Last week, we discussed about functions of board of directors, mainly after understanding or having understood the basic structure of a corporation and the role of directors. So the directors are placed in a corporation to mediate between shareholders and owners owing to its very unique nature, so that we discuss. Anyway, I am recalling these things first before moving on to today's discussion, that is corporate risk management. That is very essential to have a very good understanding about this setup. So that's why I recall it. Actually, not only corporate governance and ethics, all the other subjects that you learn, any other disciplines, maybe in finance, accounting, marketing, HR, and all, the corporation, a public company, the real structure of a public company has to be understood very well, because it becomes a legal person with enormous power to and having the legal right to exist forever if they want, and with enormous capacity to expand as they want. So therefore, it's something like a double-edged sword. It could be used for the betterment of the society or to serve the public interest in general, or to make use this particular opportunity by handful of people, including directors, managers, to defraud resources or the wealth owned by general public. So that is the situation. That is what you have learned this thing in agency theory, agency conflict. So everywhere this agency relationship exists. The base is the corporation. By taking lessons from corporation, even in other structures, a government structure is also a good example to understand this agency relationship. When agency relationship is there, it is highly essential to have good control systems, good control mechanisms, because we live in a society where we are promoted, we are always guided to maximize our own individual interests. Whenever we try to maximize our individual interests, it would clash with the interest of others. But public corporation, finally, we look or we carry out operations on one hand to maximize the profit for the shareholders, but at the same time, it would create value for the society. But this is a paradox. It does not happen in the same way. When individuals would try to maximize their own interests, it is hardly, possibilities would be left in the society or within the corporation to maximize or pass benefits to the majority. So it's really contradictory situation. With this contradictory situation, um, corporations operate, mechanisms are there, but we got to deal with these things on one hand to maximize the wealth, but on the other hand to make sure that no party's interest would be deprived. So these are the challenges. So therefore, the board of directors, the main functions, they have on one hand to assure the performance, and on the other hand, the conformities to make sure that things happen in the right manner. And they should not allow handful of people or managers, selected people to do bad things. So simple, in simple language. But it has become a daunting task, and it has been evolving as not a palatable practice. Why? Eventually, these directors also join hands with managers and create opportunities to maximize the personal interest. So that is the challenge that we have. With that aspect that we have discussed already, role of directors, now we move on to corporate risk assessment. That is also intertwined, connected to the roles or the obligations of the directors. Before moving ahead, first we will talk a little bit about risk in general, because risk is normally understood with a negative perception. When we talk about risk, we automatically what comes to your mind is, so you are going to lose something, so you are going to deal with uncertainties. It's a problematic situation, so that's a risk. Hmm? Doing something, risk of doing something, you do something, but there is a risk that you would not be able to achieve what you wanted. So that is the risk. So therefore, when we talk about finance, sometimes expected return, expected risk, and so many things have been discussed. So literally speaking, when we define the risk is a chance or the propensity to deviate from your expectation. You expect something, but there is a chance, there is a propensity to deviate from that expectation. That deviation is called risk. That is why in finance we use standard deviation and any other things or any other measures to measure the deviation. So deviation is the risk. So deviation can happen that way or this way, either positive or negative. But in our day-to-day life, so positive deviation may not be taken as a risk. If you increase your wealth, you are happy, right? So, but from corporate risk management perspective, if you gain something unexpected or go beyond your expectation, even in a positive way, that is risky. But when we talk about a corporation from risk management perspective, there is again like a kind of tendency towards the positive perception of this risk. That means positive perception in the sense, so don't take it wrong. Like when we define risk, it's all right if we can maximize our profit, increase our profit even beyond our targets. Then managers, board of directors, but shareholders may not understand this as a risk because you are doing pretty well. Your performance are increasing even beyond your expectation, right? But of course, if you can't reach your targets, right? If you cannot uh, um, reach your performance targets, your expected levels, then that is the risk. So that's why most of the cases managers would try to reach the level or just cross the level or pass the level, even though something above expectation is also risk. But from a corporation's point of view, from the value maximization point of view, again it goes back to the traditional perception or the understanding of risk with a negative connotation. Right. Keeping this thing in mind, we will move forward. So therefore, right, um, in a corporation, among all other operations, tasks, responsibilities assigned to individuals, including mainly we talk about directors. One of the major tasks is to maximize value. Whether it is right or wrong, it is a different issue. So now we talk about value creation, maximizing value. Therefore, that is our target. That's our target. What is the risk then? The risk that we talk about. The chances, propensity that we would not be able to reach that target. That's it. If you understand that, so you have understood the risk management, the concept of risk very well from a corporation point of view. I hope it's clear. Again, I repeat it. From a corporation point of view, together with the contribution efforts of both directors, managers, right, and with the support of other stakeholders, we plan to maximize the wealth within the corporation, or in other words, create value. You know, this is the amount to be created. Then you have some targets, you have plans, you have objectives, you have programs. So likewise, so certain things are there within an organization. It is the its operation. Then that is our target, our plan. If there is any chance, probability that we would deviate from that, that is the risk. Then we are going to talk about how best we manage it. Who can manage it? Many people can manage. Even managers can manage. Now, we will look at from the board of directors perspective point of view, how best they can manage it. Because they are the prime objective or prime obligations, role of board of directors is to preserve the interest of shareholders and not the interest of managers. So therefore, how best board of directors is going to preserve the interest of shareholders nowadays. We can talk from a very broad perspective, interest of all the stakeholders without depriving interest of any stakeholder. Got it? Right. So with that, we would like to cover, so talk about one important framework. Actually, there are different, so how do we do this thing? Can be explained in numerous ways. You need not to have any theories, you need not to have any frameworks, you need not to have any models. Some of the things may be learned by doing things. It's all right. But when it comes to a formal learning, sometimes we may have to use well accepted models, frameworks, and all these things. So that's what we are going to do here. So, therefore, remember that risk management tasks, responsibilities of the directors to manage risk are not limited to simply compliance or just to follow frameworks or adopt models. Don't be misled. It's very open scope. It depends. So you can use it. Some of the things may not have been written in textbooks. Directors may invent by doing things, by learning, uh, when they discharge their responsibilities as board of directors. But for the simplicity of learning and understanding, we will discuss about this COSO model, integrated model, that is the committee of sponsoring organization based, the USA based institution, which has taken into account almost of all the aspects of risk management. Therefore, it is easy for us. But apart from this, there may be some other aspects. When you write answers to questions, of course, you can be innovative, you can be creative, you can think of other models by taking into account the present realities of business context. As I highlighted in the previous lecture, now the world is moving towards some mainly from the deviating from the traditional organizational structure to a modern and alternative organizational structures where they focus on how best all the stakeholders can cooperate together and create value, and the benefits are shared in an equitable and a just manner by using the technology and by respecting environment, by minimizing social issues. So these are the lines of argument at present. but the traditional models that we are discussing have not paid that much attention, or we can say paid very little attention on all these things. So these traditional models have paid attention only from individualistic perspective. So how best my corporation can create value? Simply you disregard the rest. But if such a model, such a situation cannot last for long for sure. Right. Anyway, we will be discussing. Then again, some example, if you want, we can take the global crises such as the recent one, global financial crisis that actually not really recent, 2008. Even now, another crisis is seen to be seen, like maybe especially in the European context and the Western countries like the States, new financial crises are seen there. Symptoms of crisis are seen there. Right. The level of levels of risks can be identified at different levels. If you want, you can identify the risk as a whole. So everything. So the amount or the level of the deviation from your target profit, so the entire value maximization. But you know that the value creation takes place at different places, starting from even janitor. So if you take individuals who take part in business operations, janitor to maybe chairman, CEO, everyone contributes different ways. So for understanding purposes, their contributions, their involvement, their actions are grouped at different levels. You may have heard about basically a strategic level, that is corporate level, sometimes business level, so that is managerial level, and the operational level. Strategic and managerial and operational likewise. So not limited. If you want, you can define and think of other levels as well. Then the responsibilities for risk profiling, risk strategies, and the policies and risk supervision, risk handling, and all those things. Um, as the tasks or their obligations are different from each other, as individuals or at different levels where you operate, of course, responsibilities also change. Responsibility of the ordinary worker, employee who works at the production floor is totally different from a responsibility of a manager, line manager. And that would be different from CEO and would be different from board of directors. So therefore, now we focus the attention on directors. Identifying types of risks. Different types of risks may arise. Actually, there is a wide array of risks, different types. And then we analyze individually and together. And risk recognition and assessment. Then once we analyze risks, we would be able to recognize the impact of these risks. So what is the ultimate impact of these things on your operations, on your profitability, on your performance? So that is the assessment. And the evaluation also goes along with the assessment. And finally, how are we going to use the information from your risk management information systems? So you may access to, you can't assess it, you can't manage it, you can't deal with risks without having appropriate proper information. Sometimes organizations have risk management information systems, or organization may have one integrated information system, MIS, management information systems, within which separate part or the module may be there for the risk management information system. So it depends. Sometimes risk can be transferred here and there, so you can divert it within group structure, within different business units. We'll see whether there are any possibilities of transferring risk rather than accepting. Then as I just told you, we look at the board level commitment, not the others' commitment toward the risk management. Therefore, the board level commitment to enterprise risk management as a critical framework for successful decision making and for driving value or creating value. Uh, uh, Enterprise risk management from board point of view in a context of creating value. 1 minute. Oh, jauh. Oh, නෑ මම මේ දැන් ලෙක්චර් එකක් කරගෙන යනවානේ දැන්. මම දැන් ලෙක්චර් එක කරගෙන යනවානේ. ඒකයි මම මේ ඔයා නිසා ගත්තම මේ සයිලන්ට් මෝඩ් දාලා තිබුණේ. ඉතින් මේ දැන් ඉන්නේ ළමයින්ට කොට බලන්න. ළමයි ඉන්නවා. ඈ 1 minute මේක recording එක අපි නවත්තමුකෝ මේකට. Solve it. So we'll go back to the lesson. Right. We talk about the enterprise risk management from the board perspective, and to some extent, like our discussion would mainly go on the board's commitment and not the other perspective. But important idea, as I just told you, has been now embraced by the business world when operations are carried out. It's nothing but the stakeholder engagement. It has a kind of philosophical connection, social importance as well. As I told you, when a corporation was created, the premise was the individualism. Then everyone tried to maximize their individual benefits. But over time, people realized that that exercise is not going to do any better for the society, for business, and all these things. So it creates lots of problems. So that's why within themselves, new discussions came in. No, only tiny group of people in the board of directors or managers should not take decision. You better welcome other stakeholders or to take part in this process. So stakeholder engagement is therefore considered to be very critical in creating value and by respecting their individual interests as well. As a result, now, you know, whatever the subject that you learn, basically we talk about so significance of customers, even your competitors, environment, society, so all those things. So on and so forth. All those things are discussed. So that is the importance of stakeholder engagement. Either it works or not, no matter how hard we talk about, how deeply we embrace into these concepts, right? Some of the concepts have become only buzzwords, so there is no meaning. So name for the name's sake, we use it. But nevertheless, so this stakeholder engagement has a significant bearings from a social point of view. So that is why even in enterprise risk management, you can reduce, you can really manage your risk if the board can introduce kind of stakeholder engagement. Sometimes board creates separate committees to deal with stakeholder engagement. They specifically look into stakeholder engagement. They appoint committees, they give opportunities to other stakeholders to come forward and give you opinions or likewise. So that is the reason why when you take any annual report of a public corporation, you see uh, their work or the board of directors commitment, their contribution about the stakeholder engagement or how the stakeholder engagement takes place in that organization is explained maybe in several pages. So it's good to keep that point also in mind. But we are not going to explain or discuss today's like this aspect, stakeholder engagement, in today's lesson. But keep it in mind that that is an important concept. And move from focusing on risk avoidance and mitigation to leveraging risk and risk management option to extract business values. So, even in accounting, financial management, and business management, even our day-to-day lives, to great extent, in our practices, in our cultural practices, we tend to be a little bit conservative, isn't it? To some extent. So, so lots of symptoms and evidence are there. We are a little bit conservative. So we live with fear. If you are highly conservative, not only I don't mean that we in the sense Sri Lankans throughout the world, there may be some variations. It depends on how societies have been evolving. To great extent, I see that yes, our focus of conservatism is relatively high, I suppose, but it could be seen everywhere. So if you are in a conservative mindset, you don't like to accept risks or deal with risks. You live with fear. You follow the prudence, protection all the time. Therefore, you cover everything. No, 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 I don't want to do these things, so it's risky. Hmm? Even in the case of now COVID, there are some people, they never go out from home. They are highly scared. They live with fear, right? In case sometimes they go out and contract with outsiders, maybe because of the fear or even small drop of kind of these viruses or any other germs might cause them to have COVID for sure, because they live with great fear. So that is one. So in running businesses as well, if you explore the history how businesses were evolving, many managers, directors, investors did not want to take unnecessary risks. What they wanted was to not simply minimize risks, just to avoid risk avoidance. So sometimes if you can't fully avoid, you try to mitigate, as quickly as possible, and to do something without engaging or managing risks. That was the past. Now businesses or the world is moving towards, no, that's not the case, even though we have been doing so. Now situations are totally different. Even if you try to avoid one risks in some or other way, there may be 101 other types of risks quickly come and embrace you. So therefore, there is no point of simply trying hard to avoid risks and doing businesses. Better deal with risks, manage risks, and assess risks. Then evaluate what kind of risks with which you can deal, you can easily tackle. So you think of your risk appetite. So the level of risks that you are willing to accept, willing to deal with your capacities, your knowledge, your tools. It does not mean that you are unnecessarily going to embrace all the risks. So this is how things are being developing. I hope the message is clear. Rather than simply avoiding risks, we need to assess available risks. The very obvious fact is that risk cannot be fully avoided because new risks may come. We do not know. That is highly uncertain because you do not know what's going to happen. Especially now, technological developments, breakthroughs in science quickly alter the present situation. Unlike in the past, In the past, if you have developed a particular product, that product may last for maybe a couple of years, even without having any challenge from competitors. Now, it's not the case. So today's product may be outdated by tomorrow's technology. Even product may be there. Tomorrow's technology may outperform you at a very low cost, then you can't survive. Even though the product is very valid and useful, consumers want them, but you can't sell them at that particular price because you have used outdated technology, you have not mixed appropriate technology, now you are outdated. You got it? So therefore, risks cannot be simply avoided. You got to take it. So with that tendency, uh, what can board of directors do to manage with risk or manage risk by identifying its appropriate risk appetite? So that is the tendency. And there is a history about the evolution of corporations as well. But after some time, some landmark, or in a way we can say some milestones are there with respect to these governance issues. In the early stages of doing businesses, corporations were not there. Then investors or people invested their money and carried out business operations. But what happened over time, some business operations created huge losses, some damages to environment, society, likewise. Then, in the past, they were held responsible for the damages. Even if I started a business with 1 million rupees, if I have done a damage of 10 million rupees to the environment or losses to the society or any other activities that incurs a cost of another 100 million, I invested only 1 million. In the past, I was held responsible. No, because you did it. You are held responsible for your actions. No matter whether you use 1 million, damage is 10 million, you better pay it out of your own money, your own wealth, own properties. That was the situation. Then the business people, like investors, came forward and managed to convince authorities, the politicians, and say that so with this context, it business like the businesses will not be successful. You better create a kind of um, easy passage for us to do the businesses. That is how limited liability corporations were created with legal personality. So therefore, when you invest 100 million, your loss is 1000 million, that is 1 billion, you need not to worry as long as you have not done any ultra virus actions, right? So because your responsibilities are limited to the amount of the capital that you have contributed to the company. So this is how the limited liability logic of emergence of limited liability companies came. But at the same time, as I just explained, you have already learned. So limited liability company creates agency. As a result, another risk is the handful or the tiny group of people can misuse these funds. So it is like a double-edged sword. So in the past also, it had been some instances where people may have done these kind of things and engage in defrauding money, corporate scandals, and all those things. But in the recent past, especially what we call neoliberalism after 1970s, so corporations really engage in this particular process of maximizing its own individual value, increase even with highly qualified managers, directors, auditors. So instead of creating or maximizing value within the corporations, they try to maximize their own interests. As a result, many corporate scandals happen, starting from Enron, WorldCom. So they are like iconic cases of corporate scandals. So very unique things were shown to us. These scandals were done even though a tiny group of people did it. They did not do it alone. They did it with a cooperation of selected guys. Who are they? Directors, managers, auditors, likewise. So those who are supposed to protect the wealth get together, collude together, and defraud lots of money, what we call corporate scandals. These corporate scandals pressurize the authorities to do something. So that is how many new reports, guidelines, frameworks were introduced even before this Turnbull report in UK. So especially you know that in developed countries are taken, there are two camps. One is in the European based camp, Anglo-Saxon, that is the UK based. The other one is the USA based. So both countries have done, they given lots of efforts and lots of contributions as well. Even with respect to corporate governance, lots of documents, guideline frameworks are seen from both countries. From UK side, before Turnbull, there was other reports as well. So you can go through like Greenberry and report and Cadbury report and combined report. They combined both together. Finally, in 1999, this one came out by highlighting specific guidelines to have better governance, good corporate governance. Mainly highlighting this Turnbull report highlighted the importance or the significance of the responsibilities of the board, because the board is going to do a very significant role. So anchoring something, why? They have the control. So they are going to play a role between shareholders and the managers. So that's why emphasis has been given on the responsibilities and the obligation of um board of directors. In the States, at the same time in 2002, Sarbanes and Oxley Act was introduced, especially after these WorldCom and Enron cases. I'm not going to discuss in detail all those things, so you may have just to glance through these reports. The major ideas or the major points on those reports are the guidelines to enhance the responsibility of the directors and to comply with other requirements, maybe auditors' responsibilities, and sometimes the remedies when someone goes against these principles. Especially in, as I remember, maybe in the Sarbanes-Oxley Act. In addition to directors' responsibilities, they talk about criminal offenses. Now you should ask a question: under what circumstances, can a framework talk about criminal offenses pertaining to operations of a corporation? If you steal something or defraud something, it's a basically civil offense. It's not criminal. Criminal means, or you attempt or you kill someone. So there are categories, or maybe the definition for criminal, I don't remember it. But in general understanding, when you hear the word criminal, it's a crime. How come a crime links to a corporation? It is because of this. Because of the actions of either directors or managers. Mainly we'll talk about directors. Actions of directors may be detrimental to the shareholders and other stakeholders, then there is a chance that this particular company would collapse, would be bankrupt. If a company becomes bankrupt or would collapse, what is collapsing? Company, not merely a company, not merely an intangible institution. It is a legal person. Therefore, you are killing a person. So that is how that interpretation has been given. So therefore, if a board of director or manager engages in ultra-virus actions or some defrauding actions, actually those guys can be punished or prosecuted on crime law, that is financial crimes. But in Sri Lanka, you can do any crime and be free on the following day. You are bailed out, maybe with the influence of top politicians or other people. But we have evidences from other countries, even other countries also these kind of things are there. But if you are really um, found to be guilty of doing this kind of thing, of course, big CEOs and directors are in jails. They may spend lots of jail terms because they have done a crime. So think of these aspects, significance of the cooperation. Now, that was the premise. Now, quickly, I will go through this particular framework. As I told you, it is highly technical, theoretical, and the standard embedded guideline to use as the base for risk management. And as I just told you, it is not limited to this. You can use any other. We take this thing because it talks about almost of all the areas pertaining to risk management. Actually, there are two codes, so two frameworks. The first one I will explain the framework introduced in 2004. Then it was revised in 2017 with the collaboration of with uh, the PwC. New framework is also there, but in your slideshow, I have just the new one I have added to your presentation. But the presentation given in the LMS has only this old framework. What is it? Right? Course of definition is a process effected by an entity's board of directors, management, and other personnel. Could be directors, management, other personnel, maybe other employees, other stakeholders. Applied in strategy setting. So since it is in a strategy setting, most of these guys must be within the organization. And across the enterprise, designed to identify potential events that may affect the entity and manage risks to be within its risk appetite. Just pay attention on that word. Within its risk appetite. Unlike in the past, we do not go to highly conservative approach of just avoiding risk. We try to deal with our risk appetite. You choose the level of risks with which we can live. Then to provide reasonable assurance regarding the achievement of entity objectives. So how are we going to achieve, or how best the board of directors could help managers achieve the entity's objectives with the identified risk appetite? So that is the task. Right? So this framework helps us to do that. We'll see how. These are just some explanation. I'll quickly go to this one. So this particular framework, 2004, the corporate objectives are weaved in four categories. Four categories. What are they? Strategic, operations, reporting, and compliance. Strategic, operations, reporting, and compliance. When it comes to strategic, you may have already heard about. Always, I take this strategic word or strategy as a vague term. It's not really a specific term, even though that's my definition, my interpretation. You may have a different opinion about this thing because you can do anything with the word strategic or strategy. Whether it is ethical or unethical, you can do and claim that that is strategy. But nevertheless, this strategic approach in ERM framework refers to top level planning, so visioning and integration with mission, vision, values, and your targets. Very top level, that's what we call strategic level. So therefore, in strategy formulation, who should really take part? The top managers and board of directors. Of course, their performance roles should support to set good strategies for the company. So therefore, strategic aspect is there. The other aspect is operations. Operations are nothing but the real actions that you have to carry out, actions which are embedded in your strategies. That's it. Try to understand in that way. You have strategy, very big plan, and plans are just broken down into small parts and programs, activities, and all those things. So the carrying out all those actions are called operations. Therefore, operational level, sometimes managers, mid-level managers also make. Then you have strategies, you carry them out to achieve your objectives, but it does not complete or fulfill the um, final tasks. It does not serve everything. You need to well report these or the outcomes of your strategies, outcomes your operations, mainly your operations, maybe financing, um, day-to-day operations, or investing. Likewise, different categories may be there. Outcome of your operations and your strategies should be reported back to who? Mainly stakeholders, but legally to your shareholders. Reporting is important. In the meantime, owing to these conflicts of interests and the context within which corporations carry out their businesses, you may have to comply with certain things: governance requirement, environmental compliance, tax compliance, social compliance. There are so many things. So therefore, within risk management, so 2004 framework says that if you can cover up these four objectives, actually you are in a path of managing your risks. You need not worry that much about your risk, because once you engage in these objectives, eventually you manage your risk. That's it. The explanation is given under different principles or the areas. So these four objectives have been explained under 8 aspects. We will discuss quickly about these things. These last 2 points, your reporting and compliance requirements, really deal with what you call governance aspects. How best a corporation is governed. So the same thing. So the 8 aspects or the components: internal environment, objective setting, event identification, risk assessment, risk response, control activities, information and communication, monitoring. For the understanding purposes, we have just listed them down. Even this particular model or the framework has separated them. But in real life, in real organization, actually, you can't separate them. So actions may be taken with respect to that and this, but none of these components can be decided in isolation, because they are interrelated. That is the thing you have to understand for the examination purposes. So you may have to have some definition or key ideas about each point, but when you form a kind of um, real answer to a practical situation, you need to think of the interconnectedness among these things, interrelationships among these things. So that is how things happen. Internal environment, of course, it is obvious and everybody knows what happens within your organization. Maybe at different level establishes a philosophy regarding risk management that is within the organization. It depends on the organizational culture and behavior, your knowledge, tacit knowledge that the organization has gained over time, learning experience, and likewise, so many things are there. That is what we call internal environment, within which your organizational culture or the philosophy about the risk management. Whether it is more towards accepting or deciding risk appetite or towards risk avoidance. Then establishes risk culture. So what is your risk culture? Actually, that is connected with your risk appetite. Considers all other aspects of how the organization's actions may affect its risk culture. So that's the thing. Um, when you look at this particular third point, we need to consider all the other things, other aspects, elements within an organization, how best they are focused on the risk management or the risk culture. Why I'm saying this, when we talk about risks, risk management, and so many technical words, who most uses these words? Either top management or maybe board of directors, not ordinary employees. So therefore, there may be some lapses in communication about your risk strategies, risk appetite, and risk culture, actions, or the mitigation, or like whatever responses to your risks may not have been, chances are there, this may not have been properly communicated to all the stakeholders within the organization. Then what would happen? I might work this way, you may work that way. These two actions may contradict to each other in terms of risk management. Therefore, finally, organization will not be able to manage the risk. So this highlights the importance of the convergence of actions by all the stakeholders about risk, culture, and management. Objective settings. Objective setting should be coupled with the um, strategies of the organization. Otherwise, you would be in trouble because your strategy is something else, but objectives are not matching, not fitting. Then forms risks appetites of the entity. So it helps. So whenever you set your objectives, so traditional or the commonly known objectives, the profit or the sales target, basically maybe macro. I don't like the word maximization or this optimization, even though they are there in the textbooks and we teach and we learn. Whatever, maybe creating value would be a good idea. And what value? You may have a target, or maybe capturing a particular market share, reaching a particular level in terms of value creation, that might maybe in the human capital development or any other market presence or impact to the market. So something like whatever it is, you can have it. It helps you to think of your risk appetite. Based on your objective, you can think of the level of the risk that you are going to take. Risk tolerance and the acceptable level of variation around objectives and is aligned with the risk appetite. So once we have the risk appetite, again, it does not mean that you would be able to manage everything as planned. There may be little deviation. So within the deviation, whenever you know your appetite, you better set your limits or your tolerable limits. So these are the deviation within which I can allow. So if it just deviates somewhere or beyond this level, so that's alarming, you need to have additional measures for these things. Then the event identification involves identify those incidents occurring internally or externally that would affect the strategy and the achievement of organization. So sometimes internal situations such as employees unrests and the HR issues or production flow issues. So likewise, organizational cultural issues, so many things. So that is internal things about the risks. And external things are basically macro environmental factors, government policies, interest rates, money supply, and even foreign policies likewise. So nowadays, if you take the situation Sri Lankan context, government is facing a kind of crisis um, because of external debts, apart from other things, because external debts cannot be repaid by printing local money. You need to earn dollars. Dollars cannot be printed by yourself. So dollars have to be earned. How? Either by exporting goods or borrowing money, again, borrow to repay, or bringing foreign investments, or maybe remittances for your services such as employees, our like expatriates. So likewise, you have to earn. So nowadays it is deflating. It's going down. Our foreign reserve level is going down. Therefore, government took other measures as well. One of the measures to control the leakage of dollars or the foreign exchange, whereby imports were restricted. On one hand, it gives you a solution to deal with this issue for the government. But on the other hand, it may have counterproductive impact to the economy. Industries which have been already established, maybe importers or importing trades, or maybe re-exporting businesses, likewise maybe small and medium scale manufacturers which use some imported raw materials and all those things may have been affected on one hand by the restriction of importation, on the other hand, the restriction of this, I mean, the shortage of dollars. So these are the things you need to take into account. External uh, um, things sometimes actually happens without your knowledge. Even the COVID, external, you didn't know anything about. To great extent, internal issues also you do not know, but symptoms can be seen within the organization. If you have a very good management system or information system within an organization, it is whatever, no matter how it happens, how often it happens, and how big they are. So apart from all those things, you need to take into account all these things when you set your objectives. Addresses how both internal and external factors combine and interact influence the risk profile. Then you need to assess the risks. Allows an entity to understand the extent to which potential events might impact objectives. For example, the same example we can take in the case of foreign exchange. Now, a good example. Last week, government restricted, not restricted, really prohibited commercial banks to issue forward contract or enter into forward contract with supplier, I mean exporters or maybe traders. Why? Because it leads like since the government is facing this foreign exchange problem, and at the same time, when the banks are going to have forward exchange or the contracts, um, there would be an anomaly now. Those who have dollars may not be willing to um, translate them or exchange them with Sri Lankan rupees unless they get a satisfactory rate. Why? The yield for dollar is now greater than the yield for Sri Lankan rupees. So therefore, if they go for these contracts, the bankers will have to look for additional dollars or may have to buy at a higher rate and settle it. So likewise, unnecessary conflicts may arise due to this situation. And on the other hand, exporters may not bring their money to Sri Lanka. They might keep their money, dollars, in dollar form somewhere else in dollar accounts and earn some money because yield is higher, and borrow the similar amount from Sri Lanka at a lower rate and do the businesses. Then the situation that the country is going to face would be very severe. Because of that, you prohibit, okay, don't go for forward trade, so you exchange it at the prevailing rate, then you get uh, but at the same time, exporters and those who foreign exchange earners face a risk in future. Whenever they want to exchange, they do not know what the rate would be anyway, so that is a risk. So you can measure it. If this rate goes up to that level, this is the amount I'm going to lose. So that's a simple calculation. That is a risk assessment. Then employs a combination of both qualitative and quantitative risk management. So these are actually techniques nowadays to great extent. You need to worry about qualitative assessments. So where you need to bring about, you need to quantify the values of these non-measurable elements. But in the quantitative assessments, it is easy nowadays. You have lots of programs, softwares to measure these risks. This is how international credit rating agencies easily assess the organization by taking into account all this, because they have what they call well-developed algorithms. By using algorithms, you can easily do it. Assesses the risks on both inherent and residual basis. What are inherent to you, and residual basis, so that is at the end of the day in terms of profitability. So what would be the impact on that? Your responses. You have assessment. So these are the things to which you are going to be exposed. What are you going to do? What are your responses? Then the board of directors, you have to identify and evaluate the possible responses. So there will not be only single response, maybe range of responses. You can do that, do this. Even in the case of now prohibition of forward exchange contracts, now you can't enter into forward contracts, then you need to think of possible ways of either buying securities. If you can't go for forward contracts, can I buy or in just keep this money in the form of foreign securities? That means bills or uh, bonds in foreign denomination with a speculative amount of this money, maybe 5% interest, something like that. So different alternatives can be thought of. Then evaluates option in relation to entities, risk appetite, cost versus benefit, potential risks, and all those things. So simply speaking, the second point asks you to measure the cost and benefits. Takes different options. What are the costs and benefits from business point of view, managerial point of view, value maximization point of view? It is very simple. You need to take the stance of greater the benefit over the cost. Then go for these things, subject to other qualitative factors. So very simple rule of thumb. Selects and executes response based on evaluation of the portfolio. So it is a simple thing, action. It is pretty obvious. One, if you know the responses of them, you choose which one is best, then implement it. That's it. The other area is this control activities. As I just told you, even though we are like now more towards to deal with risk appetite, it does not mean that we are simply embrace the risks level and without having any controls. Controls are necessary. Controls are not merely for the purpose of avoiding or with a pessimistic or highly conservative approach. This is to make sure that things would happen as planned. These controls, internal controls, management controls, those things are important. Why? People, individuals tend to maximize their own interests, therefore controls are necessary. But I do not know up to what extent this would last. My personal opinion, so measuring or like achieving your targets with controls to some extent would have its own limitation. If we can reach to a level or organization or society where individuals are self-disciplined, self the respect to society, environment, and mankind, that would really last long. And control environment, what happens? As long as controls are strong, effective, and you would achieve, but at the same time, no matter how effective controls you have, how sophisticated controls you have, you would find your own ways of breaking into these controls. You bypass these controls. So this is what the history has proven us, provided the evidence to us, no matter what kind of controls we have. But anyway, I do not simply throw this idea away, but it has importance, but with limitation. Hmm? Policies, procedures to ensure the risk response and occur throughout the organization at all levels and all functions. Anyway, from technical point of view, or maybe in terms of principles, it highlights the importance of implementing controls um, evenly in the organization, irrespective of the position that you hold the institution. So it's something unitary existence, or the use of unitary control over, I mean, the use over control activities. Like in Sri Lanka also, now we call one country, one law. So the same thing. So then only you would be able to win the cooperation. You would be able to run the things with the cooperation of others. Otherwise, everyone would try to break the rules. Include application and the general information technology and controls. Information and communication management identifies, captures, and communication. I just highlighted this particular point. In most organization, lots of drawbacks are seen in communication. Communication is seen to be one-way communication, just passing messages through circulars, memos, and it does not allow or create a room to have a democratic debate or democratic exchange of ideas and views. Because in typical organization, hierarchical structure is seen. Therefore, it is unlikely that the lower level would question what the top level asks you to do. They simply I mean, uh, accept the orders given by them, commands given by them. It's your choice in a way. It depends on the organizational culture. Sometimes that might work, but so from this particular point of information and actually sharing information and communication for risk management perspective, we talk and interpret from a very broad perspective. You should not hide any information. You should not have any secret information. Things should be made freely available to everyone. Could be done easily because of technology. Technology is going to be a cross-cutting activity. Technology should not be something that could be used to uh, uh, dominate over others. So basic idea is information should be freely shared through technology. Therefore, effective communication is important if you want to really manage your risks. Then only everyone knows. Even if something goes wrong, even at the time, like small place, automatically your system alerts and gives signal back up to the top management, to the board of directors. So this is the situation. You take quick actions. Then the ongoing monitoring activities would be there, separate evaluation, combination sometimes are also seen. Don't take it wrong. When we hear the word monitoring, monitoring does not mean that simply supervision, because monitoring looks to be something that you are going to supervise. So whether it happens, no. Monitoring is just being vigilant of the outcomes, performance, actions, right? Actual actions, performance, outcomes with your plans. It is not you are checking others. You are checking your actions, your strategies with what you have achieved. It is something connected with your review. With the technology, it is much more easier and convenient for an organization, especially for the board, to do this monitoring, the very good review. Every day you can review your sales summaries, your performance, action reports can be generated, not to find fault, but to monitor the things and take remedial actions. You may revise your actions based on the information. In other words, uh, some now corporations where we talk about industrial 4.0 um, context, right? Technology 4.0 context. So that is also kind of enhancement of technologies. To great extent, robotics are being used in future. You can check in the internet what we call trade tech, right? Trade tech. So in future, most of logistics arrangement, productions, all those things would be handled by machines, and employees would be replaced by machines. It's all right, good, as long as the benefits can be passed on to the human. Do not know how the benefits are going to be shared and managed, but this is the tendency now. Robotics come into uh, these operations. Trade tech is the new trend in logistics and goods production distributions areas. Now, I'll quickly take you through this particular new framework that is not there in your slideshow. This is the new framework developed by this COSO together with the PwC in 2017. In the previous model of the framework, basic four areas were there. Four areas were there. But here, their argument is that even though they explain everything, the four aspects with eight elements, they did not talk that much about the importance of the integration in that framework. Even though the integration is there, as I just told you, one aspect cannot happen in isolation, integration is there. But this particular model heavily talks, high concern has been given or focus has been given on this integration. Accordingly, it argues that your strategizing, the director's strategizing process should focus on mission, vision, and core values of the organization before doing anything. Then only the strategy development should start, and then you can list down, uh, spell out your objective formulation, then the implementation task, and the performance evaluation. This the fourth, the level. It's not a level really, like the area, implementation and performance. The tendency is there. We are moving. Organizations are moving away from the individual performance evaluation towards group or collective performance evaluation. And finally, enhance value. That means the value creation. This is the organizational value chain in a way put into this enterprise risk management framework by COSO. So whereby this framework has been identified and put into five major categories. The previous one, four categories, here five. What are they? Governance and culture. Your organizational governance, corporate governance, goes along with the organizational behavior and culture. So they are connected with vision, mission, and values of the organization as well. And the strategy formulation and objective settings, another area. Performance, it connects with the performance evaluation. Review and revision, you can recall the aspect of monitoring in the previous framework that is similar to review and revision. Actually, it's a review. You review and you do the revision. Why? You may have set unachievable targets or unrealistic targets, or maybe due to the prevailing technology and any other situations, both internal and external factors may have altered the situation. Therefore, previous plan is not going to work. Therefore, you need to revise it. And more importantly, any decisions pertaining to revision, which comes as a result of review, should be quickly communicated to all the stakeholders within the organization. So therefore, this model is not going to be a reality without having a technology integration with the technology, because nowadays we have the technology. It is easy for an organization to pass the information quickly there by your own organizational apps or softwares, so anything. So this is the basic idea of the new form. Now quickly I will move on to some aspects of internal controls which are common, like this is a key area which has been discussed in the previous model, this model, and the codes that I showed you, combined code, and the Turnberry report, and Sarbanes and Oxley Act, and all those things, still pay more attention about the importance of internal controls. Internal control. I do not know whether it is going to be effective or not, but it is. It's a fact and a reality in organization. So therefore, strong system of internal control is essential to effective enterprise risk management. I do not, because I would challenge it. Like, it would not be something like to supervising or checking others with that mentality of that others who would not do the things. But internal controls can be embraced, respected, and implemented as your own self-control system. So, as a review and revision or tool that would help you to review your plans, strategies, and actions and revise accordingly, yes, it would be all right. I hope now organizations would take internal controls from that particular perspective. Within the risk management perspective, or the obligations and responsibilities of risks management, mm, much focus should be given to the board of directors. That's what I just told you, because they should be held responsible, because they are not supposed to engage in ultra virus. So finally, they are the people who should account and report to the shareholders. Therefore, the uh, prime obligations of risk management should lie on the shoulders of the board of directors. Then that would be passed on to managers and other officials within the organization, and to some extent, with specific responsibilities, internal auditors also. You remember, you can recall how internal auditors, sorry, are connected to internal audit committees within the board governance. To some extent, you can delegate the board responsibilities to uh, internal auditors as far as that particular actions are concerned. Therefore, in a very good enterprise risk management model or a framework should pay attention on this importance of auditing, because auditing again is a kind of process to put you onto the right path. It is not to catch you or to fall fine in the business processes. The supportive um, service or the unit to put your organization onto the, or the bring your organization back onto the right direction whenever there are deviations. It is not from a reactive perspective, but proactive and supportive perspective. So that is where internal auditors will have to work in collaboration with external auditors and internal audit committee, what we call audit committee established under the board of directors with independent directors. They should not be connect like linked to any interests with the corporation. Then only they would be able to perform their duties in bona fide and in good faith to serve the interest of all the stakeholders, not otherwise. So these things you can simply skip. You can read like all those things actually we discuss, identify risk responses, and all these things, how the things be done. I quickly show you this graph. And again, when you deal with risk or manage risks, as I just told you, you can have your own way, your tacit knowledge, your creative thinking, anything. But sometimes some models and the evidences that we have found from empirical research can be used. So this is a kind of model. It guides us to think of the level of risks and what kind of actions to be taken by the board of directors. Accordingly, uh, two elements are identified. One is the probability that that particular risk would happen. That would happen. Probability. You know that the probabilistic model, the chance, what percentage, 0 to 100%. That is the probability. Chance of occurring or not occurring something. Impact is the magnitude, the effect of it, how big it is, how small it is, significance of it. So combination of all these would determine different risk levels and actions are proposed. We'll take one by one. If the probability of happening something is very low and the impact is also very low, we call low risk situation. Nothing to worry that much. Low probability is unlikely to happen. Even if it happens, impact would be very insignificant. Nothing to worry that much. Low risk. If it is low risk, you better accept and go ahead with this. Nothing to worry. Need not to worry that much and incur unnecessary costs to control this. Let it happen. You can bear it. Probability is low, but the impact would be high. Then your little bit concern is there. Okay, risk types, some examples. Um, so yeah, good question. Like say, it actually there is no hard and fast rule that that would happen always with low probability and low impact. One example that may be with a low probability, with low impact to one organization might create a high probability and high impact to another organization. So that's what sometimes we face difficulty of just giving specific examples. It really depends on the situation. But if you take a situation like um, say probability, say external environment, probability of say revising tax policies now immediately after the government budget, the tax policies have been set, corporate tax rate. If you like, you're not sure, like some governments, because sometimes you can't simply rely on governments. We never know. You pass one, impose one rule today, tomorrow totally different one may be imposed. But corporate tax rate has been imposed. So some tax concessions have been imposed immediately after budget. So therefore, what is the chance that these policies may be changed? Generally, unless you have some internal evidence, the chance is very low. That means the probability is low to change it. Assume that even if it happens, when you earn profits, it would be big to you, but compared to other industry, your profitability would be low. Therefore, the impact of additional tax in case if the government would increase tax in an event that the government would not be able to collect its planned revenue in the current year. So by September, government was able to collect only 900 million rupees. Um, yes, 900 million against the planned amount of 1,500 something. It is unlikely that government would be able to collect. In that situation, there is a possibility, probably that the tax rate may be changed, either direct tax or indirect tax. Then what would be the impact? It depends on the size of your businesses. So likewise, it may vary to the situation from organization to organization. There is no hard and fast rule that this would be at low risk all the cases. With my example, that is at low risk. Therefore, you. So the medium level means your impact is very high. Probability is low, but you have a market share of 50% or a significant portion comes from particular industry, that is likely to be taxed. Therefore, you need to have tax sharing strategies, or maybe diversifying into some other businesses, likewise sharing a strategy, sharing strategy. So the board of directors together with the managers will have to think of. And the probability is also very high, but the impact is low. Then you can control sometimes. Why? Though the probability is high, again impact is low. So you can take the same example of tax. But if you take the high probability and high impact, that means that you know that this would happen. Risk is very high. You will have to pay more taxes. You will have to you will have to pay lots of compliance penalties or fines and all those things. Then you need to have mitigation and control things. You may need to have negotiate with authorities. You may have to show them that you have complied with all those things. You have taken some other actions, even though you have deviated from these things. So therefore, so just engaging kind of lobbying process or any other risk mitigation process. So this is how you have to think. Actually, um, it is simple from the diagram to understand, but as someone just asked, it is highly complex and complicated when you go to a real life organization. You would not be able to simply have this demarcation and thing. It happens in a complex manner. So finally, what matters, no matter whether you would be able to identify all those things, if you can foresee all these risks and communicate the impact of all these things within the organization and take remedial actions objectively, openly, by maintaining the integrity, of course, you would be able to manage your risks. And this is an example like putting into call center risk assessment. The probability, even though that is a fraud, lost transaction, employee morale, and all these things, sometimes that may be lost. But if the impact is low, then you can accept it. Likewise, um, the medium situation is probability is low, but the impact is high, maybe loss of phones and loss of computers. And high risk situation, like credit risk, customer has a loan waiting time, customer can't get through to the call center, customer can't get answers, and all those things. No solution. That high risk and high impact, because later on you would lose your clientele. Then communicating the results. Already I talk about this thing. As all those points can be explained in one point. With the help of technology, you can implement very good communication system. Actually, in organization, you can develop something called dashboards. Right? Dashboards are kind of indicative systems, like a dashboard of your vehicle. When you drive a vehicle, so dashboard indicates your water level, heat level, oil level, or even speed, everything. So you should know whether you exceed your speed or not. So that is what we call indication. So accordingly, you control when you drive along the highway. Maximum speed is 100. Now you meter indicates that 120. Then you know that you need to slow it down. The same idea, and how it is done and going to how it is going to be implemented depends on the board of directors and with the help of managers. There may be 1001 different types of solution, and therefore I even do not recommend that this is the model. Actually, the solution has to be found by the directors and managers then and there. But one aspect is important, as I just told you. Now, see, the organizations are evolving. Of course, people are becoming more and more aware of what is happening in an organization, and they are going to be aware of the value creation. In an organization, assume that this year value created value was 100 million. I'm not talking about the profit. Profit is one part of the value. Value is the entire value created by this organization. Total values of the goods and services produced and sold, say 1 billion. How that 1 billion was shared? Part may have gone to your costs for materials. Another part may have gone to some services, maintenance. Another part may have gone to employees. So likewise, another part may have been taken by the government as taxes. So likewise, different analysis can be done. That is what we call value distribution analysis. And you may highlight another part called profit. Now, big issue is many people talk about this profit. What is the corresponding sacrifice for the profit when compared to other things? So for the cost, for the salaries, sacrifice benefit is the sacrifice resource is the labor. Other services, always you may find some or other resources in terms of money or labor. But when it comes to profit, you put everything together without having a common yardsticks or any other benchmark. You claim that that is the reward for the capital, the money that you have invested. But managers or the owners who may not have contributed in real actions other than just giving money. And this is being highlighted especially in modern world organizations, especially in Europe nowadays. Therefore, they have started to talk about the organizational democracies and economic democracies nowadays. So value is created, how this value is going to be shared. So therefore, if you want to implement very good risk um, management systems, you need to be highly objective. You need to be highly transparent. You need to be open. You need to share all those things and need to agree with consensus democratically. Okay, I also take a share, but this is my share. So there are no hidden things, underhand things. So that is the proper way of managing risks in future. Otherwise, every stakeholder, every player in an organization would try to maximize their own interest, even though we claim that we are trying to manage the risk for the entire organization. It is not being managed. Why? Because you don't have any interest, you don't have any belongingness, you don't have any attachment to this thing. Because at the end of the day, each and every stakeholder knows that what is the reason for me to manage this particular risk. So this risk finally would be, or the biggest chunk of this outcome of this action would be taken by one or two people, handful of people. Therefore, just do my job and need not to worry that much. Okay. This is what we call disintegration in the business operations in future. Against this particular disintegration, integration should be implemented if you really want to have a good risk management. That is a challenge for you guys whenever you take up this position. So sometimes you may follow the given model and do the same business, but in future, in a democratic organization, democratic business places, democratic economic operations, the risk management that you learned in this class would be totally different when you are going to implement. So think from those the broader perspective. mm, that would be the future, I suppose. In technology, either we like it or not, world is moving towards. It's a matter of time. Do not know whether it is in 10 year, 50 year, 100 year, or 1,000 year. This is how society has been evolving. And the level of risks, it is always good to identify the risk at different levels. Why? Different levels are held responsible with different groups of managers. Strategic level, so who are responsible? Management level, who are responsible? Operation level, so mainly to identify the responsibilities and who should be held responsible to discharge the risks. And I don't have much time to discuss about these real cases in Sri Lankan. Um, but key questions for every director is, what is your corporate strategic exposure? What are you supposed to do? What have you learned? Your tacit knowledge, your competencies. What are you going to do with these things? Are you going to make use these things for the benefit of field or the benefit of all the stakeholders? It depends on your choice and your value system, your culture, your ethical system, all those things. But if you take recent examples from Sri Lanka and big corporation, big issues to great extent, directors are found to have not fulfilling these jobs. They simply engage in unethical practices. They defraud huge amount of money. Even the recent ETI there is an investment, EIT, right? There is an investment trust. Um, they have defrauded lots of money, but covering to the legal provisions, they have some safe haven uh, and not to be in jail. So enjoy with this money. You may bribe, and in a way, for a better society, these things should not be accepted. But due to some other reason, by and large, we general public really turn the blind eyes to these open public corruption, especially done by public corporations. Actually, the public corporations are avenues or the places where the public money can be easily misused or misappropriated. In Sri Lankan Airlines, so lots of cases are there in buying Airbuses on lease agreements and selling the canceling these lease agreements. But none of these directors were held responsible. They were simply set free and bailed out. Actually, one of the cases, the former CEO was accused by the court decision given in UK, because the Airbus was found to be guilty of giving this bribe to a shell company. You know shell company, right? That is not the shell company, that the gas company that we have. Shell company is one of the tools these crooks and corrupt people use to transfer wealth. You form a company, actually that particular company, because as I just told you, legal entity, legal personality is there, no assets at all. Your stated capital is just $1 or 10 rupees. In Sri Lanka also there was a company, I remember, as I remember, it is Lanka Logistic, only 40 rupees, four directors, 10 rupees each, 40 rupees. But you take tenders from the government because of the connection, millions and billions, you give it as subcontract and get the commission. It's easy. Right? So shell companies are companies purposely created, especially there are lots of companies in everywhere. Shell companies can be seen illegally earn money, what we call black money, uh, channeled through these things. So they are not really kept in these shell companies. Shell companies are used to channel these black monies through this company to the hands of the final directors or the shareholders. So just read these. You better read some information about this Transparency International Corruption Index. Lots of things are there. Even with this COVID, now international organizations such as IMF is normally known as an organization which promotes neoliberal economic policies and all those things and Western policies. But nowadays, so its managing director, Kristalina Georgieva, I suppose. She's highly concerned about these issues nowadays. What she says is you can listen to her. It's really worth listening. You get lots of knowledge from her videos. So her argument is the prevailing condition, unless you come out with the kind of good mechanism, control mechanism, a good governance, what is likely to happen, then the gap between rich and poor would further increase by creating lots of social issues, social unrests. It's not good on one hand. On the other hand, crooks and opportunistic people and these greedy corporations with the objectives of maximizing their personal wealth do anything. They are ready to do anything, even at the expense of the environment. So environment is simply disregarded, and that could be one of the reasons why the previous President Donald Trump um, really deviated from Paris-based environmental code. But luckily, I do not know to, in future what would happen. So the new President Joe Biden, within maybe 24 hours, has um, joined the program again, saying that environment is important, very important. Number one, society is number one. But you can think of our guys. So we try to destroy the environment, but it would be all right for the short term, but would not be good for the sustainability for sure. So all those the question I will leave them for you to discuss later on, and I hopefully I covered all those things. So if I summarize the basic aspects, so same thing is there. Um, in this chart, um, this risk strategy, profiling, policy, and supervision can be explained within an organization's the corporate structure. Irrespective of your role, your capacity, everyone has a role to perform, to do, ensure what significant risks are recognized, and risk assessment system pertaining to risks only. Now I'm talking risk assessment system exists, are effective throughout the organization, and risk evaluation procedures are whether they are operational or at what level, how best you can intervene them, and risk monitoring and review systems, and finally these risk management and the communication should be done with a very broader perspective, whereby the value can be created within an organization and the same can be shared in a just and democratic manner. And within this risk management discussion, greater responsibility can be assigned to the board of directors. Why? They are appointed by shareholders to intervene and oversee what the managers are doing on behalf of shareholders by utilizing the money, the wealth, the resources belong to shareholders in a process called business process that creates value, whereby engaging with all the stakeholders, including society and environment. So that is the future platforms for risk management and the roles and responsibilities of board of directors. So these board of directors are therefore governed and guided by well-established rules, principles, guidelines, frameworks, codes, just to make sure that they do not deviate from the prime objective of value creation, but I add value creation democratically, value creation ethically, value creation sustainably, in sustainable manner, and the value distribution in democratic and just manner. So that those things are my additions to the risk management, and I hope that this might help you to learn other subject areas as well. With that, I conclude my presentation about the risk management. Then we take the time for uh, presentation, case number 3 and 4. Thank you very much. I will upload, only I added one or two slides. I'll upload the new one to the LMS. Just